Welcome back. This is Ike Hoffman with Tactical Real Estate Solutions, and we're going to be underwriting a 78 unit distressed multifamily property. Now, this is a two-part video series. This is the second video where we'll do the deep, extensive, thorough analysis. Part one, which is linked below, covered how to qualify the opportunity first with just a few basic inputs. Now, when you're watching this analysis, you'll understand why we took that time to get the initial prognostication, as this exercise is going to take quite a bit more mental energy. In this video series, I feature two Tactica Proforma tools. I use Tactica's paid redevelopment model in this video for the full underwriting, and then I use the back of the envelope template, which is free, in video number one. Both tools are linked below in the description. If you've been enjoying Tactica's underwriting tutorial content, I'd appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. I want to give you a quick high-level summary of this property we're analyzing in case you haven't yet watched video number one. It's a 78-unit distressed multifamily property. It's approximately 50% occupied, and there's a ton of deferred capital. In video one, we estimated that there was about $40,000 per unit, or on a gross basis, $3 million that we need to put back into the property, improve it, fix any lingering issues, and ultimately improve the cosmetics to attract new tenants. We're not going to qualify for traditional financing due to the distress at the property and the weak historical financials. We'll need to go the bridge financing route. We've ran some high-level assumptions in video one, and we thought we could potentially achieve a yield on cost that's greater than 8% in a market that's seen low 6% cap pricing as of late. Now, there's a lot of logistics and execution that we'll need to work through, and that's going to take place between purchasing the property, fixing it, and stabilizing its operations. We're going to need a more granular underwriting showing the details of the renovation, and Tactica's redevelopment model is the perfect tool for this. But before we get into the actual pro forma, first we need to look at the financials. Hopefully the broker or the property owner has given you things like the rent roll, historical financials. Maybe you've talked to some contractors and you've put together a CAPEX budget, and then the property tax information, which can be found online on the county website. So let's start by looking at the rent roll. I have the key data summarized in these three columns, and depending on the rent roll format you receive from the property owner or broker, you may need to take some additional steps to get the critical data out of it into a similar format that can be analyzed. Now, I've put a ton of time educating other investors how to take these raw rent rolls and pull out the key essential pieces of information while ignoring the fluff. So if you need more help and you feel like you maybe have rent rolls in the past that you don't really know how to slice and dice it, I have a YouTube series on that as well that I'll put in the description. Pretty much all the units at this 78 property were month-to-month leases. There were only like a handful, like two or three that actually had lease expirations, and there wasn't a lot of time left until they expired. So I only pulled the unit types, specifically whether it's a 1-bedroom, 2-bedroom, or 3-bedroom unit, the square footage of each unit, and then the in-place leased rents. Well, that's a good start. There are a few more items that I want to assess in this rent roll. I just want to know how many units are currently occupied. We have the most recent rent roll, so I'm just going to do a count formula, and I'm going to highlight all of the rent amounts in column D. And we have 41 occupied units. We take 41 divided by 78 total units. The property is 53% occupied. And we can just do the same thing for vacancy. We'll take 78 minus 41. And then 37 divided by 78 total units is 47% vacant. And then what I'll do is I'll highlight these three columns. And I'm going to insert a pivot table. And I'll insert it on the existing worksheet, just a couple cells below our occupancy data. And first I'll drag the type down into the row argument. So we have 1-bedroom, 2-bedroom, and 3-bedroom units. And then I'll drag the type down into the values so we can get a unit count. So there's 36 1s, 27 2s, and 15 3-bedrooms. And then I want to know the average square footage. So I'm going to click on that little down arrow, and I'll click value field setting, and we'll do the average instead of the sum. And then I want to know the average in-place leased rent of each unit. Right now it's doing a count. I don't want to count. I'll click the field settings and we'll do an average. And so now we have the average rent of 1s, 2s, and 3-bedroom units. Now down below, I'm just going to paste this pivot table as value. So I'm going to hit Control-Alt-V. We'll select values up in the upper left-hand corner. And then I'll make the headers bold. And then I want to do a rent per square foot calculation. So we'll take the average rent divided by the average square footage. And then I've also spent some time offline looking at rent comps. Now, I feel like over the years, I've gotten far more efficient and have discovered resources that have really helped expedite and find better, more accurate rent comps. So I will provide some links in the description on how I attack these rent comps. But just know that there is a good amount of analysis that took place outside the context of this video to really hone in on these rent comp per square foot rents. We think there's potential for 1 bedrooms to achieve $1.71 per square foot, 2 bedrooms $1.70 per square foot, and then 3 bedrooms $1.55 per square foot. And then I want to just take that per square footage and apply it to the actual units at the 78 unit property. So I'm just going to multiply it by the average square footage. So we get that target rent in chunk terms. So 1325 for ones, 1653 for twos, and then 1801 for threes. This is going to be our target rent. And then finally, we can back into what that actual rent premium is. We take 1325 minus 1028, and we can just drag that formula down. So for 1 bedroom, it's about $300. For 2 bedrooms, $517. 3 bedrooms, $488. This will be really important data once we dive into our Proforma and start inputting our renovation strategy. Now let's hop over to the financials tab. We received a T12 financial statement from the ownership group. It was broken down monthly, so I was also able to put together what the T3 revenue was as well. I like to see the latest revenue trend when I'm doing this type of analysis, and T3 is kind of the industry standard. But generally speaking, financials of distressed properties are less insightful than that of stabilized properties. In a lot of instances, you just throw away what's been happening at the property. It's not a great benchmark. And similar to rent roll, depending on the financial statement format, it may take some steps to get the numbers into a digestible format that's easy to copy and paste into the Proforma. I also have a YouTube video that shows you how to tackle this. Let's hop over to the CAPEX assumptions. So we received a few different bids on the renovation scope, and we're just going to roll with these numbers for now. Once we input this data into the Proforma, we can control how this money will be spent, or rather, when it will be spent in the renovation timeline. And then the final piece of information is property taxes. I went on the county website and I downloaded the latest property tax statement. It is kind of an awkward time of year, right? Like I'm making this video in late 2023. In this particular market, taxes are paid a year in arrears. The 2023 assessment will dictate what the investor actually pays in property taxes in 2024. So we know what's going to be due next year. Unfortunately, year two's a little bit murky. We don't have that assessment yet for what the 2024 assessment for 2025 payable would be. That's going to come out in the next couple of months. But as we input this data into the property tax section of the Proforma, I will show you kind of my thought process and a few different ways you can go about this and underwrite it hopefully in a little bit more of a conservative manner just to be safe. Now that we've summarized a few different pieces of financial information, let's go ahead and hop into Tactica's redevelopment Proforma. Let's get right into it. Let's go to the Reno Inputs tab of the redevelopment model, and this is where we'll input everything related to the renovation as it applies to the interior of units. Now, when you're looking at this for the first time, it might seem a little intimidating, but the beauty of this tab is the flexibility. It allows investors to really paint the picture of how they want their renovation plan to unfold. There are 8 sections that you can enter in different renovation assumptions. I think of these sections as like pieces of paper where you're going to write your renovation story. Just because there are 8 pieces there doesn't mean you need to use them all. It just offers a lot of flexibility. I don't want to get into all the different ways you can use this tab in this particular tutorial. I think I do a very great job of that. In the actual redevelopment tutorial that's posted on the sales page, I'll link to that YouTube video below. The analysis actually starts off to the right here if we scroll over. Remember, we spent some time looking over the financials, specifically the rent roll, and we made that pivot table and then organized everything nicely where we had the unit types, the unit count, average square footage, average rent, and rent premium. Well, now we need to get that information. So I'm going to copy and paste as values the unit types and then the average square footage of these unit types. So paste those in as values as well. And then down below in the air checks section, we need to post how many units there are of each floor plan, the average rent, the average targeted premium, and then the average capital. The capital we deciphered on the CAPEX budget. That was $15,000 to kind of $20,000 for the larger units. Paste that in as values. And now we have our high level renovation plan inputted off to the right here. The method I'm using, the blended method, we can tap into this information to save time as we underwrite this deal. You can see when we're actually putting in our renovation assumptions, there's a drop-down menu here. We have the 1 bedrooms, 2s, 3s listed, then there's a space, and then blended. Blended is what we'll be using once we begin putting in the assumptions. Now we have 78 units here, and I want to renovate approximately 10 units every 3 months. There's also a lot of vacancy at this property. About 50% of the units are vacant. Well, I think it's truly 46 or 47%. And I want to handle those first. There's no leases attached to them. They're ready to be renovated. It just seems logical that we would attack those ones right out of the gate. So the first 4 sections are going to be dedicated to the vacant units. So I'm going to go ahead and I'm going to copy and paste the section name. And then we plan to do 10 units every 3 months. So each section will span 3 months. Generally, I'll make some alterations of that as we're moving. That would leave us 7 vacant units. There's 37 total vacant units. So the last section we would dedicate to 7. And then our month start is 1. The rehab duration will be 3 months. And then the lease up, we assume, would take 1 month. We don't need to worry about cash for keys or enticing residents to vacate the premise early. These are all vacant. And then we need to make a general post-rehab assumption. So I think after these units are renovated, they'll consistently be 94% occupied for the remainder of the Proforma. And then we can do a annual increase, rental increase post-renovation. I'll do 2.5. And then the final assumption is for concessions. I think there's a lot of demand for these units. I don't think we'll need to give away concessions, especially early on in the lease up. However, to be conservative, I will allocate some concessions to units that we renovate later on in the renovation timeline. The average rent at the property is $1,120. The blended premium we're targeting is $409. And then the blended capital is $16,827. And I just need to grab that we're doing the blended rent. It'll grab the square footage, the rent per square foot for us, the targeted rent, the targeted per square foot. And what's nice is once we have that entered in once, we can copy and paste it. I'm going to go ahead and just do it in all 8 sections, and I'll make some tweaks to the count as it's needed. And then we can go to section 2. A lot of our assumptions will be the same. Our rehab duration for these 10 units will take 3 months. The lease up, 1 month. No cash for keys. There is one additional assumption. General occupancy pre-rehab. These are all vacant units, so it would be 0%. Post-rehab, again, would be 94. And then 2.5% rent growth annually once these are completed. And then 0 months of concessions again. We'll continue. Month start for the third section is 7. It'll take 3 months, 1 month of lease up. That would bring us to month 11. For this section, there won't be any cash for keys. General occupancy pre-rehab will be 0%, post-rehab 94%. Annual increase thereafter 2.5, and there won't be any concessions. And then finally, the remaining 7 vacant units. I think we can do that rehab duration a little faster. There's only 7 units instead of 10, so we'll do it in 2 months. We'll say the lease up still takes 1 month. No cash for keys. General occupancy pre-rehab 0%, post-rent 94% again, and then 2.5% increase thereafter. Just to be conservative, I will start putting in some concessions. I'll do a half month of concessions for these last 7 units. Now 37 of our units are accounted for. Now the final 4 sections will be dedicated to our previously occupied units. So I'll name this first section remaining units. The month start is 12. It'll still take 3 months because we're going to do 10 units. The lease up 1 month. Cash for keys. Now, even though there were occupied units, as I mentioned earlier, pretty much all the leases were month to month. So we don't expect that we would need to entice any other residents to vacate their lease early. But we can now put in a general occupancy pre-rehab. I mentioned the property is 52% occupied. So all of these occupied units will be paying some rent during the first year when we were tackling the vacant units, which will be nice. It'll help bolster the pro forma in year one. The general occupancy post rehab will continue to be 94%. And then we'll do 2.5% again for the annual rental increase post renovation. And now we'll do 1 month of concessions for these leases. So we're getting towards the end of our renovation, and it might get a little more challenging. We don't know really what the market's going to look like a year from now. So we want to be more conservative with our underwriting. And to save time, I'm actually going to take all the data from above and I'll just copy and paste it below. And then I'll take remaining units from over to the left because these are units that have been occupied. And we'll make sure we enter in that 52%. Everything looks good. We'll do a month of concessions and make sure that we're doing 10 units again in this block. And then I will take everything from these 2 blocks and paste it below. Everything looks good in this section. And then the final thing I want to do is notice off to the right, there's a warning. Only 77 out of 78 units are included in the analysis. Verify all units are entered into the input section. So that's a nice little warning. We're 1 short and we want to just add that last unit in this last section here. So now we have an 11 unit count. The one thing I do want to change though is the rehab duration to make them consistent with the other blocks where we're doing 10 units. And now this tab is officially complete. From there, we can hop over to the Reno Summary tab, and it shows really at a high level what's taking place here at the property. You can see that in the upper right-hand corner, we have a nice little summary of the Reno time frame. We have what that vacancy would look like. So just a ton of vacancy in year 1, about 55%. It's really cut in half in year 2. And then by year 3, we have our stabilized vacancy of 6%. We have a nice summary of the numbers here. The key cash flows on an annualized basis. So we're ramping up that net effective rental income all the way up to $1.35 million in year 3. And then there are some charts summarizing the CAPEX spend by month and also the unit renovation summary by month. Now let's hop over to the CAPEX plan tab. So the first thing I want to point out is all of that interior capital, so the $16,827 per unit is flowing through to this tab already. What we need to enter in is the capital that we're going to be spending on the common areas. So remember in our financial statements we reviewed earlier in the video, we had some expenses laid out. We'll get those copied and pasted into the model along with the amount. And then we can allocate how this capital will be spent throughout the renovation timeline. So we would want to knock out the hallways right away. It's a first impression thing, right? When people are touring these units, we want the hallways to look nice. Otherwise, they might lose interest before they even step into the unit. We'd want to knock out the roofs right away, especially if there were water intrusion issues. So we'll do that over months 2 and 3. Plumbing, take care relatively early in the renovation timeline. We do painting early as well. A lot of exterior and common area painting. This isn't unit interior painting. And then common areas, that's another great way to make a first impression. Everything else will be kind of allocated over the entire renovation plan. So project management, months 1 through 23, any contingency and marketing. Just want to point out if for some reason you have a projection that goes beyond the unit renovations. So we're renovating all these units in 23 months. We'd be leasing up the last one at the end of year 2 in month 24. So if we put in something like 26, it glows red. It just shows you hey, this project management, why is it allocated out further than your renovations taking place? All of these common area things should be wrapped up by the time you wrap up the interior units, and conditional formatting will warn you if that's not the case. If we go back to the Reno Summary tab, these graphs, these charts update nicely so you can see that now we're factoring that common capital into this CAPEX summary by month, which may help you visualize how the money will be flowing into this project. And just one more thing to point out on this tab, Your timing of these CAPEX expenses will affect the interest expense. If you're using a standard bridge loan that you're drawing on to complete these repairs and renovations and improvements, the earlier you draw in the renovation period, the higher that accrued interest expense will be. Now, right now, the interest expense is zero. We haven't put in like our financing assumptions yet, but once we come back here and check on it, you'll see it can make a material impact on your total interest expense if you're doing a lot of your spending during the first few months. Let's jump over to the real estate tax tab next. So we have, if you watch video one, you know we're looking at this property. The price being negotiated is at $6.5 million. That's flowing in right now from the investment summary tab, which we'll get to eventually. And then we need to make a reassessment post-sale assumption. For now, I'm going to use 125%. Give me a moment and then I will explain that more thoroughly. But we expect the reassessment year to happen in year 3. And then after that, we expect property taxes to increase at 3% per year. We don't have a ton of tax information right now, so I'll delete most of the data here. All we have at this point is the assessment of $10,340,000 and the 2024 payable of $189,003. There aren't any discounts or special assessments. And year 1 of our Proforma will be in 2023, 2024. So let's talk about what's happening here. Basically, the taxes are set for our year 1 of the Proforma. We know that we're going to be on the hook to pay $189,000. The assessment for 2024, which would be payable 2025 in Proforma terms, our year 2, is not out yet, but it should be soon. So let's go ahead and make an assumption for what that's going to be. I'm going to say that it stays the same. I think there's a lot of evidence that this might actually decrease. There's been some sales that have taken place lately that are showing that the market's softening and that valuations are coming down. But we want to be conservative, right? Like in year 2, we're going to be doing a ton of renovations, and it could be a nice boon to the pro forma if the assessment drops. But we don't want to bank on it. So let's leave it where it is for now and just make sure the numbers work at that level. Then in year 3, there's going to be a pretty significant drop in the assessment. I mentioned the market softening. There's some sales comps out there that have been about $100,000 per unit. That property is very similar to the one we're looking at. So we're solving for approximately $104,000 per unit assessment. That feels like it's very reasonable. Now, you could probably make the argument if you purchase this property for $6.5 million, you should be able to call the assessor and say, hey, the market value is $6.5 million. That's what I paid. So if you put in 100% here, you can see in column J, the taxes payable in year 3 dropped from $148,000 to $118,000. Let's take a middle ground here. We know that there's comps selling for in the low 100,000s, and let's earmark our property to that. And then we can maybe come back to this tab and see how the pro forma would look if we could truly pay $6.5 million and get 100% reassessment post-sale, see how that impacts the numbers. Let's next hop over to the financials tab. So to save time, I already inputted that T12 revenue and expense that we had in the financials document. And then I also put in the T3 revenue as well. We don't have any further back historical information, so I will just hide columns E and F. And then I'll just hide this T3 revenue column. We have it summarized annually then in column I. Historical financials have been problematic. I think it's pretty obvious when the net operating income is negative. We need to reinvent the wheel a little bit, figure out what's been going wrong, come up with a totally different management style. And that's what we're going to brainstorm then over to the right are these operating assumptions for years 1 through 10 of the pro forma for each one of these unique line items. So if we come over to column V, we can begin making our assumptions. What's nice is everything that is rent related, so like your rent growth, your rent premiums, your concessions, vacancy loss, that all ties to the renovation inputs tab. The first tab we were on, the assumptions we were making on this tab flow through to the financials tab. So if you want to make changes with how things are showing up on the financials tab when it regards rent, you're going to have to go back to the reno inputs tab and make the changes there. The first thing we can do is make an assumption for bad debt. I'm going to run it at -2% in year 1. That's kind of in line with where it's been historically. You can see we're solving for 22,000, -22,000 in pro forma year 1. those units, those 52% occupied units, they're the same tenants that have been there historically. So there's probably going to be continue to be some softness when it comes to renters paying rent consistently. As we renovate units and bring in new tenants, I expect to cut that down significantly. We'll run it at -1% in year 2 and then -0.5% when the property is totally stabilized. For now, I'm going to skip over some of these ancillary income items, garage, laundry, utility reimbursement, and other. The reason is we need to put a little bit more thought into these underwriting assumptions, right? Because while we think we can get, $50 for 72 garage spots, it's going to take time to phase that in. There's going to be a ton of vacancy on the rent rolls in years 1 and 2, and we want to factor that in when we're making our assumptions. So bear with me, I'll get back to that. Now let's make some expense assumptions. So with any of these line items, you can make assumptions 3 different ways. You can do it as a percentage increase over the previous year. So like if we wanted to underwrite admin at 3% over T12, we would type in 3% into column W. Or you can do an assumption as a percentage of the total revenue. So like management fees commonly underwritten as a percentage of EGI or your effective gross income. So I'll put in 5% there. But really when we're doing a deal that's distressed, the historical financials aren't as meaningful. So I kind of want to start fresh and make some per unit assumptions. And that will be the baseline of the expense underwriting that will kind of carry through then through the rest of the pro forma. So to start, I'll underwrite admin at 300 per unit. I'm going to underwrite marketing at 0. Why am I doing 0? Because we're already accounting for $30,000 of marketing in our CAPEX plan. So this is the money that will be used to lease these units as we're renovating them. So from an operating standpoint, I don't want to double count it, so I'll leave it at 0. Payroll, historically at the property, payroll was under 100 grand. We're going to really bump that up. I think part of the reason this property got into trouble, there just weren't enough resources at the property, and we really need to invest in the people that are taking care of this property. So I'm going to put in $1,800 per unit, which is nearly $50,000 more than what payroll has been at the property historically. Utilities, I'll underwrite at $1,300 per unit. It's pretty clear that there's probably like leaking toilets and other stuff that can be taken care of relatively easily. So $1,300 puts it at $100,000, which is about $25,000 less than what it's been historically. R&M, I'm also going to put at 0. Why 0? Because we have a $3 million capital budget as we renovate these units and fix common areas. Anything repairs and maintenance related should be factored into that budget. We don't want to double count. And then we'd be able to get an insurance bid. We'll say we got bid at $450 per unit, which is $35,000. And then the property tax assumption will be flowing through from the real estate tax tab, the one we were just on. And then I'll put in $300 per unit in reserves. Now let's make our year 2 expense assumption. So now that we kind of have our baseline, most of these are made on a per unit basis, I'll increase the admin 3% over the pro forma year 1 amount. Marketing will continue to be $0 in year 2. We'll still be using the marketing budget that we put into our CAPEX plan. Management fee will be 5%. And then I'll increase payroll at 3%, utilities at 3%. We'll continue to run R&M at 0 in year 2, and then insurance will increase at 3% as well. Just to note, another conservative thing I'm doing in this pro forma, I'm actually growing our operating expenses more than kind of that residual rent growth. And then finally, you can see once we get into year 3, there's only one way to make an assumption. There's only one column dedicated to the pro forma year. So for everything except the management fee, it's just a percentage increase over the past year. So I'm going to do 3% here. And I'm going to teach you a little trick. It's a little weird, right? Because marketing was 0 in year 2. And we can't, because it was 0, we can't apply an escalator to that and get to our stabilized amount. If let's say we expect the stabilized marketing per unit to be $300 per unit. A little trick I use is instead of putting in 0 here, I'll do 0.01. So 1 cent. I mean, it's nothing. It's still essentially 0. And then I will do 300 per unit, right? Divided by 1 cent. And then I would come over here and type in 3%. I want marketing to increase at 3% every year thereafter. So then you can see it bumps up from $1. You can even, I'll just add another zero. So it shows up as zero in the pro forma. So it goes, marketing is zero, it's zero, and then it gets up to its stabilized amount, which is 23,400 or 300 per unit. So management fee will continue to be 5% of revenue. Payroll will increase at 3%, utilities at 3%, and then R&M, I'm going to do the same thing I did with marketing. So if we expect stabilized R&M to be 1,000, I'll first come in to 0.001, and then I'll do equals 1,000 divided by that 0.001 minus 1. And then we'll increase it at 3%, R&M at 3% every year thereafter. So it stabilizes at $78,000, which is $1,000 per unit, and increases 3% thereafter. And then insurance will increase at 3% a year. Let's go back to our other income and continue underwriting that. Now, I mentioned earlier, I want to tie that into our occupancy. I'm going to create a separate grid down below that makes this more intuitive. So I'll say year 1, year 2, year 3. And then I want to track the vacancy. And I'm going to go right to the Reno summary tab and grab that year 1 Reno vacancy and just drag that down. And I was actually one row off, so let me just drag all of that up one row. So year 1 through 3, it starts at 55%, gets down to 24% in year 2, and then vacancy, once stabilized, will be 6%. And then I just want to make these all a positive. So put a minus sign in front of it and then drag it down. And then for occupancy, I'll just take 1 minus the vacancy. And then I'll list out garage, laundry, utility, reimbursement, and other. I'll actually put that down one more row. And then we need to track a few different things. The quantity of each ancillary item, the monthly potential, the annual gross. I'll go ahead and wrap these text cells so it's easier to read. And then annual per unit. There's 72 garage spaces. For laundry, we'll allocate that over 78 total rental units. For utility reimbursement, the same, and then other income, the same. I think the monthly potential for garage is about $50. For laundry, we'll say it's $15 per unit per month. For utility reimbursement, $40 per unit per month, and then other income, just $20 per unit per month. And then to get the annual gross, we just take the number times the monthly charge times 12 months. We can drag that down. And then we need to revert that back to a per unit. So we'll divide that by 78 units. Now we can underwrite our ancillary income based on the occupancy schedule. For year 1, garage parking, I'll take the occupancy in year 1 times the total per unit potential. For laundry, do the occupancy in year 1 times total potential. Same thing for utilities. And then other income, same thing. In year 2, I'll follow the same logic, except I will take the occupancy in year 2, which is 76%, times the total potential. And then in year 3, we can just take the full potential amount divided by year 2 per unit minus 1. And then after, we'd increase by 3% in year 4 and thereafter. We'll do the same thing for laundry. So we take 180 divided by 137 minus 1. For utility reimbursement, 480 divided by 365 minus 1. 3% thereafter. And then other income, 240 divided by 182 minus 1. 3% rent growth thereafter. Important to note, I am increasing the ancillary income at 3%, which is in line with our operating expenses. However, our rents, which are the most impactful in the pro forma, will be increasing at 2.5% from year 3 through year 10. And then once we scroll over to the right, we have nicely summarized 10-year operating cash flows. The last thing I want to do is just look at our stabilized expenses. So I'm going to come over to year 3. This is when the property's fully stabilized and everything now, all of our operating revenue and expenses is ramped up. I want to take our total expense divided by our total revenue, and we have an expense ratio of 43.87%. It's a little more aggressive than what we had originally solved for in video 1. If you recall, we used a 45% expense ratio, so we're beating that estimate a little bit. And then I just want to look at the per unit expenses. And so I'll take the total year 3 expenses divided by 78 units, and it's 8,221, which feels reasonable for this asset class. Let's now jump over to the investment summary tab to put the finishing touches on our underwriting assignment. So let's start in the upper left-hand corner. I'm going to ignore some of this qualitative data. It doesn't affect the numbers. The current occupancy at the property is about 52%. There's 72 parking spaces. Now we can put in our financing assumption. So we're going to use a bridge loan. Say the LTV is 65%, the interest rate 9%. We got a 36-month term, which is about a year extra of buffer. We expect to wrap up this renovation in 2 years. And then the interest accrual will be standard. Standard is beneficial to the borrower. So this loan is going to give us proceeds both for the acquisition of the asset and the CAPEX that we'll use to renovate it. I've seen and heard of agreements that will essentially start accruing interest on the capital portion of that loan on day 1, even though those funds haven't been drawn yet. When you elect standard here, it means that CAPEX won't accrue interest until you actually draw on it. So standard would be advantageous for the borrower. And then we'll say the loan cost is 1.5% of the total loan amount, and we'll say, yes, there is an interest reserve. Because there's so little cash flow, especially early on in the renovation, you're going to need help paying that interest that this loan is accruing. So the interest reserve is basically funds set aside to pay that interest expense. It will require you as the investor to bring more equity to the table, though. If we come over to the right, we can populate our closing and residual assumptions. We'll say that escrow legal closing costs in year 0, so like this is to purchase the property, would be $134,000. And we'll say that as sponsors, there's going to be a 1% acquisition fee. We'll say the residual cap rate today is 6.25%, and that will increase out 0.1% annually. We'll say the brokerage commission, when we decide to sell it, will be 1.5%. And then other closing costs will be 1% of the residual sale value as well. And we're not going to put in any kind of residual sale fee. If we come back over, we can now go down to the project level metrics. We already put in the price of $6.5 million. We're doing a 10-year hold period. Let's next put in our refinance metrics. We'll say the cap rate at refi will be 6.5%. The LTV of the loan, 65%. And then we'll just do the refinance month in month 24, just to kind of round it out. We'll get it right at the end of year 2. And then we need to put in our permanent financing assumptions. We'll put in 7% for the interest rate. There has been some momentum with interest rates falling. 7% feels like a good amount and a decent cushion right now, but you should definitely be checking up on the capital markets, talking with lenders, and updating this assumption as it's changing. We'll do a 10-year term, 30-year amortization, a loan cost of 1%, and 12 months of interest only. So now when we look at our project level metrics, first thing that jumps out is these cap rates are negative. Remember, the historical NOI was negative, so they don't make a lot of sense at this juncture, so we can just hide them. I'm just going to make the text white so we don't see them. And then our stabilized yield on cost is 8.08%, so pretty close to what it was when we did that very high level underwriting assessment in video 1. If you had any other costs or you wanted to put in like an operating reserve, you could do that in this section, the sources and uses. We're not going to do that for now, but that is an option if you're using this tool. And now let's hop over to the return summary tab. This is really kind of the culmination of everything we've plugged into the model so far. We have everything flowing here, our cash flow assumptions, the capital we're spending on the renovation, our loan draws, our financing, so both the bridge loan interest and the permanent financing once we're able to refinance and get out of that bridge debt. We have the refinance assumption here as well. It looks like we'll have about 1.7 million in refi proceeds at the end of year 2, and then all of our residual sale assumptions are summarized in the bottom section. We have our IRRs, equity multiples, cash on cash return, all summarized then at the very bottom. And my first thought, just kind of looking at these numbers, is I don't know if there's enough here, right? Like, I was looking at value add deals just a couple of years ago, like cosmetic value add. There were deals that weren't even distressed, and they were kind of targeting these kinds of returns that we see in years 7 through 10, kind of that 17 to 16%, even 15% leveraged IRR. This isn't much higher than that, yet we know the market's softer. We know it's more of a buyer's market. Values are down. And this deal has a ton of moving pieces. There's a lot of risk and execution risk, especially with this renovation plan taking over 2 years. So I kind of wonder if there needs to be some concessions on the purchase price, or maybe there needs to be more rental upside, but we vetted the rent comps very well. I don't know that, I would be in love with this deal looking at it as like an LP investor. It gets better if we reduce the purchase price. If we take, say, $500,000 off, the leverage IRR over 10 years gets to almost 20%. That feels a little bit better, and then even more importantly, that stabilized yield on cost is approaching 9. But that's what's fun with this model. Now that we have everything plugged in, we can come back in, we can tweak our renovation assumptions if we desire, we can change our CAPEX as we're getting real-time information from contractors, our property taxes. As I mentioned, there might be a way to be more aggressive here. Maybe we go to 100% of reassessment. So we're going to see a bigger property tax reduction in year 3 than earlier. We come back to investment summary. Now that stabilized yield on cost climbs up to 9. It's starting to look better, but we don't want to bank on assumptions that we're not sure of, that are outside of our control. We really want things to make sense and be excited about the return prospects with assumptions that are bankable, that hopefully we have more control over as investors. A couple other tabs I haven't talked on yet. There's this refi debt tab. There's nothing you need to do here. This just hosts all the financing information. It hosts the amortization table off to the left, and then those loan cash flows or payments here in this hidden section. You can just hide that, make it look a little cleaner. Quite a lot goes on here behind the scenes, but there's just nothing you physically need to enter in. This is the IRR sources tab. I've written a lot of content on this, how 2 deals with the same IRR aren't necessarily equal. There's different ways to earn that yield. And this is kind of a unique way to look at the IRR and see where yield is coming from compared to other deals you've done in the past. But I'll put some links in the description. I talk just a ton about the IRR metric specifically, and also IRR sources, as I call them, in this tab. And you can learn a little bit more about what I'm doing on this tab and what it's meant for. And then finally, the blue tabs, we have the partnership distributions. I'm not going to go into too much depth here. I have separate YouTube videos, separate blog posts really covering these things from head to toe. But if you wanted to play with different contributions and different waterfalls, so we'll do maybe a first hurdle and a second hurdle, 16%, and then a little promote after that. You can play with these different partnership distribution models and see how the returns look for both the sponsor and the LP investors. It also has like your fees. If you're a GP and you're charging acquisition fees, dispo fees, whatever they are, those are summarized here as well. And then this data will all flow back to the investment summary tab. So you can see if we scroll down to the bottom right-hand corner, I have the simple interest waterfall selected. That was the tab we were just on. And all of that data then is summarized and condensed, where you can show your partners or your potential LPs what the returns might look like if they were to invest with you. Ultimately, it's up to each investor to define their risk threshold and determine an adequate return. At a purchase price of $6.5 million, I don't know that the juice is worth the squeeze. A lot of things need to go right within our Proforma to hit a mid-teen leveraged IRR. And quite frankly, these were the return thresholds that were standard for far less intensive value add projects just a few years ago. But now the market has softened considerably, and I think as investors, We need to be certain that we can execute the business plan and earn sufficient profitability with adequate cushion for the unexpected. With Tactica's redevelopment model, we can efficiently analyze the hairiest of projects needing total repositioning. We have a ton of control over every assumption. We can get incredibly granular with the renovation plan and stress all project assumptions to ensure we are getting the most out of our investment opportunity. We can revisit our model as the market changes, update assumptions, and tweak inputs as we negotiate. If you've been enjoying Tactica's tutorial underwriting content, I'd really appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video footage. And that's going to sum up the distressed underwriting tutorial. I appreciate you following along and look forward to creating similar videos in the near future. Take care.